Interest rates about to be cut. Hey everyone, it's Wolfgang. So today the Federal Reserve made a presentation at Jackson Hole, Wyoming. I want to discuss what he said. Basically, a lot of things that he said. I'm going to break it down into several sections, starting with what his main announcement was today at Jackson Hole, Wyoming. He said that we may need a change in interest rate policy. So everyone assumes that means interest rates are about to be lowered. They certainly would not be increased, right? Everyone assumes that he meant it's time to change policy to start lowering interest rates. So the job market, he announced, was the main reason. He said there is downside risk to employment and it's rising. His full statement was, this unusual situation suggests that downside risks to employment are rising, and if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. So everyone assumes he intends to lower interest rates at the next opportunity, which will be September. So we're expecting, and so is the market, and I will explain in this video how this affected the market. Everyone expects interest rates are going to start dropping. So yesterday, the NASDAQ closed at 21,100. This was Thursday, right? Because today's Friday. Yesterday, Thursday, the NASDAQ closed at 21,100. Today, the low was a little bit under that. It was 21,092, about 8 points below yesterday's close. And that's as low as it got today. Because as soon as he made this announcement, we may need to change policy. There was a big spike up in the NASDAQ, a big spike up. So the reason would be once the Federal Reserve makes an announcement and people start thinking that interest rates will drop, they assume that means the economy will start growing again, that they're taking off the brakes a little bit, the Fed is, to allow the economy to grow. The NASDAQ jumped up 500 points. That's huge, a huge jump in the NASDAQ. It closed at 21,496. So it closed yesterday at 21,100. At today, the low point was 21,092, a little bit less than the 100. It jumped up to 21,496. So that's an increase of over 500 points. That's huge for a one-day jump in the NASDAQ. The reason that the NASDAQ jumped is because people assume the economy will start to grow again, okay? So lowering interest rates, we're going to allow people to borrow, more people to borrow, because what this will do, if interest rates are lower, that increases the size of the pool of people who will qualify for debt. You know, credit card debt, mortgages to buy a used car or a new car. So lowering interest rates grows the economy. The NASDAQ jumped up quite a bit. Okay. So let's talk about the effect on gold prices. 33.63 was the low for gold today. It jumped up after he made this announcement. We may need to change interest rate policy. We may need to lower interest rates. He basically means we are going to lower, unless something very strange happened that no one expects. They're going to lower interest rates in September. So gold spiked up from 33.63 to 34.17. Now, why would gold increase? So you have to think about the effects on, on bonds, on the dollar. Is the U.S. dollar weakening? Would people who own or buy gold tend to want to hold something that has a more stable value? The answer is yes. Gold closed up today. It jumped from 33.63 up to 34.17. So if you tend to invest in gold in your portfolio, you probably noticed that the price of gold jumped a little bit today. Okay, so what was the effect on bonds? And this is kind of a big deal because this has many tentacles. When the Fed changes interest rates, all of a sudden there are two categories of bonds. Bonds that are already sold with an interest rate that was announced, right? They're bonds that were sold last month, the month before, the year before. They had interest rates that were announced at that time that they were sold. New bonds are different. New bonds will have a lower interest rate, okay? A lower return, okay? So think about a 10-year treasury bond sold 2 years ago. It's a 10-year bond. It has another 8 years left. It was sold 2 years ago at a particular interest rate versus a 10-year treasury bond sold in 2 months, sold 2 months from now, August, September, October, right? So a treasury bond, 10-year treasury sold in October of this year is going to have a lower interest rate. Guess which bond is worth more? They're both 10-year bonds, right? But guess which bond is worth more now? It's the bond that was sold 2 years ago because it has a higher interest rate, okay? So when the Fed changes interest rates, it doesn't immediately affect the interest rate on bonds sold in the past, but it does affect bonds that will be sold in the future. Newly sold bonds are going to have a lower interest rate. So people will not want them as much, will not pay as much because the return is lower. So bonds sold in the past, their price would tend to go up relative to bonds sold now or in the future that have lower interest rates. Okay. So that is a change in how people, what people expect bond prices to be. They expect that 10-year treasuries in the past are suddenly worth more because their interest rate was higher. New bonds will have a lower interest rate, so they're not going to be worth as much. Slight difference in the price. So the effect on bonds. Prior sold bonds have rates that are now effectively higher than the new bonds, and so they will rise in price. People would rather buy a 10-year treasury with a higher interest that was sold a few months ago than to buy a 10-year now and get a lower interest rate. So bonds are going to rise in price because interest rates have dropped. Newly sold bonds will have a lower return. And people don't like that, right? People want a higher return. They tend to like higher return. So new bonds will have a lower rate, and so they'll have a lower price. So the change in interest rates will stimulate the economy, right? But if you make your money by investing in bonds, because there are some people, they used to be called coupon clippers, who don't really have a job. They make their income from the interest on bonds. They just buy really safe bonds like treasuries, like 10-year treasuries. They make an income from the interest. Well, if they buy 10-year bonds now, they're going to be buying bonds that have a lower return because interest rates are going to drop. So this does have an effect on bonds. The interest rate change has an immediate effect on bonds. It puts them into two categories. Bonds sold previously that have a higher interest rate, and new bonds that are going to have a lower interest rate. Okay, so how will that affect the housing market? How does this change in interest rates affect the housing market? So there is some good news, although you can't get too super excited about it. So it's possible that we'll have lower mortgage rates. Possible. Because the mortgage rate, the interest rate on a home loan is based on the 10-year treasury. And if the interest rates for the 10-year treasury are lower, then seemingly the housing market should see a boost because home loans should become cheaper. The interest rate on home loans, on mortgage loans will have a lower interest rate, right? But there's a problem. The problem is why is Powell even thinking about lowering rates? I'll go back to the statement. This unusual situation suggests downside risks to employment. Downside risks mean the expectation is there's going to be a drop in employment. Downside risks to employment are increasing. If those risks materialize, if the job market gets even softer than it is now, in other words, it can happen quickly in the form of sharply higher layoffs and rising unemployment. So while this decline in interest rates will make it possible for more people to take out a home loan, the problem is the reduction in the interest rates is due to the job market being soft. And when you're concerned about your job, you know, your first thought is not, let's go out and buy a home, right? When you're concerned about employment, you tend to want to be a renter. So it's not clear that these lower interest rates, which could reduce home loan interest, it's not clear that that will improve the housing situation that we have right now. So long versus short-term rates. Okay, so I want to explain this because this is a little bit sort of unknown to the general public. So bear with me. It's actually pretty straightforward. There are two ranges of interest rates, long-term interest rates and short-term rates. Okay, so I want you to think, if you were around, if you can remember the Great Financial Crisis, 2008, 2009, 2010, that time frame. The Fed was buying long-term bonds. They were buying bonds that would increase demand for the bonds. Whenever you increase demand for anything, its price will go up. And because with a bond, an increase in price lowers the interest, that lowered the long-term interest rates back then. That was during the Great Financial Crisis. So the long-term, if the Fed buys the 10-year treasury, that will help the economy. The Fed is not doing that right now. The only thing the Fed is doing is they are lowering interest rates. They are changing interest rate policy. They're not really doing anything to affect the long term. It's not like they're going out like this is the great financial crisis and the economy's in trouble and we have to stimulate it. Let's go out and buy 10-year, 30-year bonds. The Fed is not doing that. But those are the options. The long and the short-term rates, they're controlled as part of monetary policy by the Fed. The Fed sets interest rates to affect the short term. The Fed buys or sells bonds, 10-year or other duration, to have long-term to have long-term effects on the economy. There's long-term and there's short-term. Right now, the Fed is only doing short-term rates. They're only changing short-term rates. So the effect is it's not going to be directly on, we're, in the Fed's opinion, we are not economically in bad shape compared to the great financial crisis. So they're not going to buy bonds. Okay, so the bigger story, I couldn't fit everything on the board here. So this is, it goes back to what Powell was saying today in Wyoming. So let's say that he carries through, he lowers interest rates at his first available opportunity, which is in September. And let's say that mortgage rates drop. So if rates are lower, but people are afraid of their job, not only do they not go out and buy a house, are they actually going to go out and buy a car? Are they actually going to think about using debt? In general, no. The bigger story is that, not only do people who are concerned about the job market, not only do they not buy houses, they tend to buy fewer cars, use credit cards less, and so on. So lower interest rates are being done for a specific reason, and that reason is the job market. So we're going to have to pay attention to the job market. And the one thing I wanted to mention here, the bigger story, is the rate of continuing claims. If you look up continuing claims for unemployment, that will show a pretty large spike starting in around 2024 and rising to a high level and staying there. So there's a lot of unemployed people who have been unemployed for a while. And so this change is going to help, but it's going to take this is just my opinion, it's going to take quite a while for the longer term unemployed to find work again, because Powell is, they're lowering interest rates. My expectation is they're going, based on the way he talked about this, he's going to lower rates by 25 basis points only. They probably need to drop 1 full percentage point. They probably need to drop 1% to have any kind of effect. But Powell has been, it's not that the Fed doesn't care about people who are struggling or these long-term unemployed people, but he thinks he has a particular job to do, and he's trying to do that job. And at some point, someone will probably get hired into that job, and they may lower rates more substantially, because the time to lower interest rates was actually, a few months ago. So if you have any questions about this, it's good news that we're finally seeing a change in interest rates. That's the crux of the whole video. We're finally seeing a change in interest rate policy. Powell today and for a while has been admitting that interest rate policy has been restrictive on the economy. They have been preventing the economy from growing because they were so concerned about inflation. But now they're seeing such stress in the job market, they're going to start lowering rates. That's a good thing. So that's kind of what the bulk of the video was about. So if you have any questions, please post in the comments. I'd be more than happy to answer any questions you have. And I really want to thank everyone for watching. Have a great day.